Let's touch base with a very, very important management. I'm talking about HDFC Limited on their fundraising drive. They've already raised 14,000 crore via the QIP route. Mr. Keki Mistry, Vice Chairman and CEO of HDFC Limited, joins us right now. Ms. Mistry, thank you so much for joining us this evening. The company has raised 14,000 crores via QIP. Can you tell us how the response has been?
All right, so we took an approval from our shareholders to do a total issue of 14,000 crores. We've broken up the issue in two components, in two instruments. One is direct equity, which is a 10,000 crore rupee issue, and the other is a warrant structure where it's a NCD cum warrant, and the warrant holder has to pay 10% of the last issue, last dated the price prevalent on the last day. When the issue opened upfront, that was the warrant premium. And then the warrant gets converted into shares at the end of 3 years at a premium of 22% to the price prevalent on the day of the issue. So effectively, it's 10% paid upfront and 22% paid at 3 years later. So the money for the warrant has come in now, but the equity portion, which is the conversion portion, when it converts into equity, that money will come in at the end of 3 years. So 10,000 has come in now, and the remaining will come in 3 years later. The issue received a very good response, extremely good response. I can't get into numbers and things like that, but it received an extremely good response. And the issue was launched at a price of 1,760 rupees. The price of the share on the day we launched the issue, which was last Wednesday, was 1,776 rupees. So roughly it was a 1% discount to the closing price of the share on that day. We got a very large number of people who applied for shares stroke the warrants. And totally, we had something like 100 distinct fund managers who applied for the issue, both foreign and domestic, and largely long-only international foreign institutional investors, and also domestic funds and domestic institutions. Totally, these different funds would have something like 300 plus different accounts in which the allocation would be made. The maximum dilution that could happen because of this issue, assuming the shares get converted into equity 3 years later, would be about 4.2%. So roughly it would be a 4.2% dilution in terms of the equity, in terms of the net worth. But if you look at it in terms of number of shares, the dilution would be significantly lower. And the money is going to be used for growth, both organic growth and inorganic growth. And we believe that in the course of time, there will be opportunities both for organic and inorganic growth in a big way, both in the core business as well as in our subsidiaries. Also, what happens is, as you know, HDFC has built up a lot of value in terms of the value of our various investments. The unrecognized gain on our listed investments on 30th June, the day of the last results, was 1,92,151 crores. So there's a huge value which is built up. But under the accounting standards, any investments that we make, or under the regulatory norms, any investment we make in our subsidiaries, or for that matter in the bank, gets reduced from Tier 1 capital. So whilst there is a huge value accretion that comes in, straight away at the time when you make the investment, it gets reduced. The investment gets reduced from Tier 1 capital. So that is the reason why we were looking at a capital issue.
What about the plans to use these proceeds? What are the opportunities that the company could be looking at? Given that we would see consolidation within the NBFC space, what kind of inorganic growth opportunities, perhaps, if you're looking at any?
We believe that there will be a lot of growth opportunities in all our businesses, whether it's in the core mortgage business, whether it is in any of our subsidiaries. And we believe that these growth opportunities will be there for a fairly long period of time. Specifically, there is nothing we have on hand today which I can talk about, but obviously we'll be on the lookout, and whenever we see a good opportunity for an M&A transaction, we will be happy to look at it. But of course, organic growth will take place irrespective. It will continue.
We are given to understand that the liquidity issues are back in the NBFC space. Given the tough macro environment, Mr. Mistry, only quality players will be able to raise money. And well, there's no doubt about the brand of HDFC, but how are you seeing the funding and the liquidity scenario as an industry insider?
See, we are not really, frankly, gathering any concerns as far as liquidity goes. I think liquidity is available in plenty. Money is available. I mean, I must compliment RBI for what they've done in terms of ensuring that there is so much of liquidity which is available in the system. So whilst there was a certain amount of tightness in liquidity in the early part of April and the latter part of March, I think it has been extremely well addressed by RBI. So today, to my mind, there is no liquidity concerns at all. Right through the first quarter, which is April, May, June, we had maintained an average liquid balance of close to 32,000 crores. We believe that going forward, we do not require to keep such a large amount of liquidity in the balance sheet because we see that the liquidity position in the market is now very, very comfortable.
In the past, Mr. Mistry, you've spoken about one-time restructuring of the real estate loans. Given the stress in the real estate space, what coordinated efforts do you expect RBI and the government to sort of take to address these challenges?
All right, so let me tell you that the pressure is not only on the real estate sector. I think there are many other industries that have been affected by COVID, whether it is hotels, whether it is hospitality, whether it is airlines. And if these sectors have repayment of liability, which comes up post the completion of the moratorium, and they've not been able to operate their businesses, or some cases even start their businesses, then their ability to pay off these liabilities as and when they mature gets significantly impacted. So therefore, a restructuring is something which we really truly support. I think it is in need of the hour. The only thing which we feel is that when the restructuring should be allowed for all standard accounts, all accounts that were standard on 1st of March. Which is what, in every standard account on 1st March, moratorium was allowed. So similarly, on every standard account, restructuring should also be allowed. To my mind, the policy currently says that the restructuring would only be allowed if the outstanding was less than, I think it's 30 days or less than 30 days. That might be a challenge for some of these sectors, for some of these industries, and for some of these companies. But other than that, I think it's a very welcome step on the part of RBI, and I think it's truly the need of the hour. But this, as I said, I'm not talking with reference to real estate. I'm talking generally for various industries which have been affected during this period.
The pandemic has resulted in people realizing the need for their own house, their own office. Do you see any demand and sales going up with more people wanting to buy their own property? Share with us any trends that you're spotting at the moment.
Sure. So let me start with the first quarter to begin with. As you know, we had the lockdown, which happened from the 22nd, 23rd of March, and that continued right up to the middle of May. And then selectively, the lockdown was lifted. Some places it was lifted faster, and some places it was lifted later on. Like Mumbai opened only on the 8th of June, and Mumbai even today operates with only 10% of the staff working from office. April was therefore more or less a complete washout. May we started seeing some traction develop, but it was relatively small because by the time we could really open our offices, we were into probably 17th, 18th, 19th of May. We did roughly about 2,300 crores of disbursements in the month of May. June was a lot better. We did nearly 6,500 crore plus of retail. I'm talking about retail loan disbursements. So we did a little over 6,500 crores of retail disbursements, and we achieved roughly 68% of what we had done in June of the previous year. July turned out to be very good. We disbursed about 7,614 crores of individual loans during that period, which was actually an 18% increase over what we had done in the month of June, and was roughly 81% of what we had done in July of the previous year. So the momentum has picked up a fair bit in the month of July, and we hope that that kind of momentum will continue as we roll out the remaining part of the year.
Mr. Mistry, given the low interest rate scenario, how do you view the return on assets trajectory shape up?
See, we have been doing this for the last many years, plenty of years. And we've gone through so many different interest rate scenarios where the rates are coming down, rates are going up. And we generally manage to maintain our spreads in the same band because we link our lending rates to our cost of funding. And as cost of funding has declined over a period of time, we have also lowered our lending rates, giving the benefit of the lower cost of funds back to our customers. And therefore, in the process, we have generally managed to keep our spreads at more or less the same level. Net interest margin, I'm not talking of the second quarter because all that is not in public domain. But if you look at the first quarter of the year, our net interest margin for the first quarter was 3.1%, which was lower compared to the first quarter of last year when it was 3.3%. But the reason it was lower, the 20 basis points lower net interest margin, was only attributable to the fact that we were keeping a significantly higher level of liquidity in the first quarter of this year versus what we were doing in the previous year. So if we look at the 32,000 crores of liquidity which we had during the quarter and reduce from that what we had in the previous year and then apply the negative carry, it would be to the tune of nearly 181 crores. So if you add that 181 crores to the net interest income for the quarter, your net interest margin will go back to the level of the previous year, which is 3.3%. So high interest rate environment, low interest rate environment, we manage our ALM position very well.
Analysts and even economists expect bad loans to rise. Now, RBI in the recent financial stability report mentioned the fact that NPA ratio may escalate to 14.7% under the very severely stressed scenario, of course. How critical or how detrimental do you think this could be for the overall banking system and lending patterns?
I think NPLs is one thing. Non-performing loans is a very technical thing because if someone has not paid 3 installments, the loan gets classified as a non-performing. What you have to really look at is losses. What is the losses that will ultimately come about? You may have a loan which gets classified as a non-performing loan, but generally, if you believe that over a period of time, the business will come back, assuming it's a business loan, the business will come back to normalcy, revenues will start flowing back again, then you would tend to believe that whilst you may have an increase in NPL, you will not have an increase in the losses. So a lot depends on the kind of funding that the relevant bank or NBFC or whoever has done. If it is secured lending and the security, for example, you take a housing loan. The security for a housing loan is the very house where the family stay. So whilst NPL numbers could go higher in some quarter or lower in another quarter, losses will be very limited because there is an underlying value of the security. So you have to analyze this in much greater detail, not just look at the headline NPL number, but look at what ultimately what ultimate losses it could translate into.
Okay, got it. Fair point. Just before we let you go, one last question. The big month to watch out is September, given that the moratorium ends in August. There have been arguments of moratorium adversely affecting the credit culture and the borrower behavior as well. How concerning, according to you, could this be?
Look, my personal view is it's not abuse the credit culture as you put it with a very long term view. I truly don't believe that. It was a temporary respite that was given to people because they were facing difficulty. They were facing a challenge because many of them could not work. Many of the businesses could not start. And, we all know that in India for 1.5 months out of the 3-month quarter, everything was shut down. So obviously businesses would have been impacted. But gradually we have seen, and we are seeing this every day, that the economy is picking up. Economic growth is beginning to pick up. Yes, from a relatively low base of of April, May, but it has clearly picked up. You see in our own case, 7,600 crores of disbursements in the month of July, which is 81% of what we had done in the previous year. So things are getting better by the day. So my sense is in the medium to long term, and even if someone has availed of a moratorium, I don't see that having a long-term impact in terms of credit impact. Now, if you are to look at specifically for the month of September or the month of December, I mean, how the NPL numbers for the banking system as a whole is going to shape up or not, one will have to watch. But I do believe that as industry picks up, whilst there might be short-term problems or short-term rise that some of the banks may face in terms of NPLs, I don't see it having a long-term effect in terms of impacting their standing.